Welcome to our Taking Stock episode for the week ending the 17th of March 2023. I'm Kien Trinh, Head of Research at Stock Doctor, and joining me today is our Equities Analyst Daniel Ortisi to stream to you all things share market. Great to have you on board, Dan.
Good to be back for another week of Taking Stock, Kien.
But before we get started, just a reminder that the information provided today is of a generic nature and therefore shouldn't be considered personal advice. Remember, shares are volatile and any historical performance figures may not represent the future. Well, Dan, volatility is certainly back over the week with widespread panic across those global banking stocks, which began with the collapse of Silicon Valley Bank and Signature Bank in the US early in the week, followed by concerns over this financial stability of European bank Credit Suisse. But unlike the smaller US banks, Credit Suisse is much more globally interconnected, and problems have ignited after its largest shareholders stated that they would no longer pump any more money into the business. The lender has been embroiled in a raft of scandals in recent years, which has battled its image and balance sheet credentials.
That's absolutely correct, Kien. In an effort to manage the contagion, regulators have announced emergency measures to shore up the banks by giving them access to additional funding and guarantee depositors. But the key question for many investors is whether this could lead to another Lehman Brothers event, which triggered the global financial crisis in 2008.
Yeah, that's right, Dan. We don't really know how this could pan out, but the risks are certainly not the same. What we do know so far is that Credit Suisse share price is down about 40%, and it raised about 50 billion Swiss francs to shore up its balance sheet. But another thing to note is that unlike Silicon Valley Bank, Credit Suisse does have a high liquidity coverage ratio at 191%, and this represents the portion of cash and other assets that can quickly be accessed in a crisis. In addition, over the last decade, the global financial environment has strengthened significantly after Lehman Brothers went bankrupt, with banks now more tightly regulated, and they do have more capital to manage this risk.
That's right, Kien. Bond yields have reacted by plummeting worldwide as the market abandons its views of further interest rate rises due to the concerns that further tightening could exacerbate the severity of the financial system and lead to a severe global recession. In Australia, bond futures are suggesting that the RBA will keep its cash rate at 3.6% for the next 2 months.
Yes, bond yields tend to be a proxy for interest rate expectations, but this rapid change in investor sentiment has led to a sell-off across our financial sector, especially among those stocks that are most sensitive to this rising interest rate cycle. Within our star stocks, we've seen significant volatility across Computershare, for instance, Challenger, Suncorp, Netwealth, Hub24, and of course, those banks as well.
Yeah, that's right, Kien. And that's because these companies are considered beneficiaries in rising interest rate environments, either because they generate margin income from client account balances or have investments in fixed income portfolios. Banks, on the other hand, have been weighed down by the contagion fears. For example, customers may withdraw their deposits, forcing banks to have to access higher cost of funding sources, which in turn could place some pressure on their profit margins.
Yes, but as you all know, volatility can create opportunity. And regardless, we do believe the significant sell down across these stocks could represent opportunity for investors once share price volatility subsides. It's important to understand that the share prices reflects investor sentiment rather than the strength of the balance sheets. Positively, though, the Lincoln US funds don't have exposure to Silicon Valley Bank or any US banks. And our financial health model is protecting us from investing in those speculative businesses such as startups, which have relationships with higher risk banks like Silicon Valley Bank. In times of crises, these so-called zombie companies with no cash flows are most at risk of corporate failure, especially if funding options dry up.
Absolutely, Kien. And from a risk management perspective, it's prudent for investors to remain well diversified. Invest according to your stage of life and tolerance to market volatility, and be prepared to ride out the economic cycle. Having some cash on the sidelines can help you manage the volatility and allow you to take advantage of opportunities if quality stocks are sold down. Currently, the Lincoln Growth Funds have around 20 to 35% of their allocation to cash.
Yeah, and one of the reasons for that, Dan, was following on from the reporting season, we did mention that earnings expectations remain too optimistic, and we believe that further earnings downgrades were on the horizon. And you can see this highlighted with the chart on screen, which shows a large disparity between earnings forecasts, and that's in black compared to the All Ords index in blue. In this environment, our research team is putting more emphasis on the qualitative aspects and active risks of businesses when making stock selection decisions. And early in the week, we did initiate coverage on Endeavour Group. For those who are not familiar with the company, Endeavour operates a portfolio of liquor retailers such as Dan Murphy's and BWS, along with a portfolio of hotels as well. Liquor sales tend to be historically resilient to the economic cycle, but with its net profit margins quite low at around 4.6%, Dan, is this enough buffer to absorb a large economic shock?
Yeah, that's a good question, Kien. And if we can all recall, the business was spun off from Woolworths not too long ago, and its earnings and cash flows are relatively defensive, like you mentioned, and considered more of a staples type business, particularly as Australia has a high alcohol consumption per capita. So similar to Woolies and Coles, with its thin net profit margins, we do not view this as a material risk. In fact, the outlook remains positive, with consensus analysts upgrading its earnings by nearly 5% over the last 3 months due to that strong reporting season.
I also noticed that the free cash flow, Dan, is expected to rise strongly and support its gross dividend yield of around 4.7%. And now moving on to our corporate calendar, there are not many events next week, although Star Income stock DDH1 with a gross dividend yield of about 10.9% is due to go ex-dividend on the 20th of March, followed by Credit Corp Group on the next day. And the yield on that, the gross dividend yield, is around 5.8%. And in Under the Microscope this week, let's focus on Kelsian Group, which is Australia's largest private operator of metropolitan public bus services. Long-time Stock Doctor members may have recognised the company as the old Sea-Link. The research team has initiated coverage of the company last week, and the company has already announced a US acquisition. So Dan, what is our investment thesis for this stock?
Yeah, that's right, Ken. And the company, it is quite different now compared to the old Sea-Link days when it was primarily a ferry and tourism operator. And following the transformational acquisition of Transit Systems in 2020, the company is now Australia's largest land and marine public transport service provider. We are quite keen on the company's domestic and international public transport contracts, which provide an infrastructure-like revenue stream. And the characteristics of these provide what we consider resilient revenues, even during periods of challenging market conditions, which is primarily our investment thesis.
Yeah, much needed in this time of volatility. But currently, the company also operates in the UK and Singapore. And it seems like management wants to expand its tentacles to the US via this acquisition of All Aboard America. So, Dan, how large is the acquisition, and should investors participate in this equity raising?
Yeah, Ken, well, the US acquisition is fairly large and will contribute to around 22% of Kelsian's total revenue. The deal should help improve the overall net profit margin, which is currently around 5%. And given that the capital raising comprises of a large debt component, we could also see an improvement in the return on equity of the business. With this in mind, an entitlement offer of around $5.55 does seem like an attractive proposition, especially given that the stock was already trading at a 15% discount to consensus targets prior to the announcement of this deal. However, investors need to ensure that they understand the active risks of the business, such as the sensitivity to wage inflation.
But with the company already holding a significant amount of debt on its balance sheet, Dan, do you think the company is vulnerable to a deterioration in its financial health with this additional $226 million of debt?
It's a great question, Kien, and one our members would be asking for sure. So its balance sheet ratios, such as the total liabilities to total tangible assets, is already in marginal financial health, and this additional debt could potentially tip the company over to an unsatisfactory level. However, what we must remember is that the increase in debt is also coinciding with an additional increase to cash flows and assets from the new business. In addition, the majority of Kelsian's revenue is recurring and contracted, which reduces the variability in its operations. This means that it could theoretically tolerate higher levels of leverage. And this dynamic is similar to other infrastructure-like companies that also exhibit, typically higher debt levels.
Yeah, interesting, Dan. We will certainly be monitoring the balance sheet ratios very closely, but currently its net debt to equity ratio sits at a modest 56%. But it's also good to see that management has significant skin in the game, with the CEO and all Kelsian directors collectively holding around 22% of shares on issue. So on this issue around the global financial turmoil, a good question this week for income investors is, are the Australian banks vulnerable to collapse, like what happened with Silicon Valley Bank in the US?
Yeah, and to provide some context here, Silicon Valley Bank specializes in banking services for tech startups and venture capital companies. This bank has faced problems when interest rates rose rapidly, with depositors wanting to withdraw funds, forcing the bank to sell its long-dated bonds at a loss to meet those withdrawals. And with the threat of capital raisings, this created a cascading effect for even more withdrawals, leading to its demise as a typical bank run.
Yes, but we do believe the banking situation in Australia is fundamentally different from that of the US. Firstly, the Australian banking system is not heavily exposed to a single industry like Silicon Valley Bank is. Furthermore, Aussie banks have a more diverse deposit base here, and their asset portfolio largely consists of variable rate mortgages and business loans. Additionally, the Australian banks invest in shorter duration assets, which potentially reduces this interest rate risk.
That's right, Kien. And APRA requires duration risk to be hedged across the balance sheet, and regional banks here also face similar levels of scrutiny as their larger peers, unlike in the US. This means that all Australian banks need to have a liquidity ratio over 100% compared to the only 65% for Silicon Valley Bank. This provides an ample buffer to satisfy withdrawals. Moreover, Australian regulators have withdrawal limits in place to protect banks from a bank run, such as the $10,000 per day limit.
Yes, given the safeguards in the Australian banking system, we don't believe that local banks are exposed to the same level of idiosyncratic risks as their US counterparts. However, if a credit event similar to the one in 2008 were to occur, this could become a systemic issue with potential ramifications extending beyond the banking system themselves. But as we've seen in the past, these events do not occur often, but when they do, can create significant opportunities for investors. Well, that's all we have time for today. Thanks, Dan, for your contributions.
It was great, Kien. A very tricky episode for investors, but hopefully there was great information for them.
Yes, remember, don't be fearful of volatility, embrace it. But just also a reminder that Lincoln Live is on Monday again, where our team of experts, including our CIO, Tim Lincoln, Matthew Swartz, our portfolio manager, and Rob Manfrey, our technical expert, and of course myself, will be able to help you navigate the markets and answer all those questions you have. But to summarize, really, it's about risk management in this episode. You've got to invest in those financially healthy businesses, really stay diversified, and also invest according to your stage of life and risk tolerance. And during these times, markets can become quite irrational. So have some cash on the sidelines to take advantage of opportunities when they arise. Take care and have a happy, healthy, and prosperous week, everyone.